right? So to us traders, what leveraging would mean is using what we know to our maximum, to its maximum advantage. What we know is this price action here, right? We need to analyze this price action and know what exactly is going on. So once you know what exactly is going on within this chart, within this price action here, then now you can use that information that you know to its maximum advantage. That is generally what leveraging means. So let's drop down timeframes and see how we could have traded this this specific price action based on leveraging, right? So let's see now how we could have traded this through leveraging and grow out the account, right? So from here, right? So what we know is that we know we have a high and a low. We know we have a breakout structure in the high time frame. We also know that we have a supply zone in the high time frame, right? We know that we should now drop time frames according to the rule of 30 to go and confirm this area, right? Lo and behold, that's exactly what we do. We go down and we confirm this area. Confirmation in terms of what, right? Basically, all we need to see is that intermediary trend going bullish to now shift and start what? Going bearish. So all we need to see is a breakout structure and a retest at an S&D zone in this rule of 30 time frame, right? And then trade now these all the way down to this specific or major low, right? Which is our next liquidity run. Now from there, let's check out this price action and see what we got. So, okay, I think this is perfect zoom. What we had was a series of highs and lows being made, right? Highs and lows being made, right? Highs. So from here, what happens? Price now decides to break lower and form a new low. Same case scenario as in the high time frames, which means what? This market is now ready to go bearish. Lo and behold, all you need to find is that S&D zone in which price is basically going to tap in, right? Boom, like that, because I did say that, you know, wicks themselves stand as their own S&D zones. So that there is your confirmation. All you need to do is place your sell order there, your stop loss above the high or the zone, whatever you choose, and the take profit target is all the way down here. Now, let's not get carried away, right? So let's go back and revisit what we know. So what do we know in the case of leveraging? We know price in the high time frame is bearish, right? We had a breakout structure in the high time frame. We had a high and a low. We also had an S&D zone in the high time frame, which is now mitigated. And when we come to the lower time frame, in accordance to the rule of 30, what do we have? We have, again, a low and a high with a breakout structure and a retest to an S&D zone, which means what? Our confirmation is complete. So our SSC rule structure, S&D confirm, is complete. So what we know is that all the things that we have are complete, right? So this price is now ready to move from this area here, all the way down to this area here, right? Because this is our next liquidity run in the higher time frame. So this is what we know. Now we need to use what we know to its maximum advantage, which basically means that we need to get as many entries as possible, right? As many bearish entries as possible, because we know that this market is ready in all accordance to go bearish from this area here to this area here. So what we need to do is position ourselves as much as we can throughout all this trend until we reach this low. That is what is called, that is what leveraging refers to. Using our knowledge, using what we know to its maximum advantage. So we need to position ourselves because we know this market is going bullish, bearish. We know this market is going bearish from our S&D zone to our low, which is our next liquidity run. So we need to use this information to position ourselves as many times as possible throughout the trend. That is simply what leveraging refers to. Lo and behold, let's dig in and see how do we do that. How do we leverage? So leveraging is simply done by following the actual trend and your rules, right? So we know that from here, since we're on the lower time frame, we can no longer confirm unless you have even lower time frames. I mean, like here you're on the 5 minute, right? If you have the paid trading view, you can drop down time frames even to seconds. Then you could actually reconfirm this area if you want to sell it, right? As in the process of leveraging. But if you don't, that, it's regardless, a trade is a trade. So you could actually position yourself here and just extend your stop loss just to play it safe, right? But unless if you have the paid trading view and you have access to the even lower time frames, these seconds time frames to be specific, then you can reconfirm this and have a much tighter stop loss, which would actually, allow you to have a bigger lot size open. So you know that it is what it is. So from there, so that's our trade number one. And from this area now, because we know that this market is going bearish, then the next thing we're going to be waiting for is a break of this low, which happens right here. So in this case, we now have a high and a low. Lo and behold, what happens, right? We need to wait for price to make a pullback, or need to wait what? To an S&D zone, right? An S&D zone in terms of what? The last place in which smart money actually bought before they sold really hard, right? So as you can see, price here came down, they bought, and then they sold really hard, right? So this area here, from this low here, and as you can see, price comes, taps it, leaves, right? So this is your entry, yet again. So this is like your entry number two, your stop loss, above the high, and you're looking to target whatever is all the way down here, right? So this is how we do leveraging, right? This is using the information that we have to its maximum advantage. The next thing you know is what, right? You now have a high and you have a low. What's next, right? You know that, okay, so there's a breakout structure here. Obviously, there's going to be a retest to an S&D zone. An S&D zone is where the last place in which smart money bought before they sold, right? So, as simple as that, your S&D zone, right? Boom, right there. And you're having what? Another short position open, right? So patience is key. You just need to wait, right? Even if price tends to leave, right? Because with according to the max, I mean, to the research that I've done, right? I can call it research or whatever, but it is what it is. So according to this, some sort of research that I've done, right? Sometimes price can actually do this, right? Price could do that, and then you could have an S&D zone there, right? And then price could come almost and then drop, right? And then it would come again, mitigate, and then leave you that very good confirmation and then leave, right? And then drop even lower. These highs right here, right? There's this tendency of price making a pullback, and that pullback not tapping an S&D zone, ending up in the middle and then continuing lower. You should not fear this, and you should not consider this as an S&D zone. No, these normally act as liquidity highs. They contain liquidity above them, right? Because they are swing points in which that liquidity will be used to fuel up this pullback, to come mitigate this, and make that a tremendous drop, right? And as you can see, this is what exactly happened right here, right? So price breaks a low, comes up, comes up, comes up, right? As you can see, that's our S&D point, right? But price never touches it, and instead it leaves, and upon leaving, price accumulates once again, comes back, taps it, and then look at this momentum that price leaves with, right? So price leaves very hard due to what? The liquidity taken from this high. So this is just like a concept I felt like sharing with you, So yeah, I hope this, one day you'll come to understand it, and it will make a lot of sense, and also make you money and prevent you from, actually losing money. So from there, you can actually target the low, right? So this is how leveraging is done. You need to be very careful with the structure you're picking. Only pick up the major structural points. As you can see, I'm not considering these highs in here. I am not considering these highs and lows in here, right? Why? Because they are intermediary price action. They are simply, they don't matter, right? They don't matter. We don't give a fuck about them, right? They are simply, what can I say? They don't matter. They don't matter. You know, like that's the simplest language that I can use. They don't matter, and we don't need to give a shit about them. We should only focus on major structural points, right? So from this low to this high, what do we see next, right? A break of structure. Oh, so there's a break of structure, right? So now we have a low and a high, and we have this S&D zone. Look what price does. Price comes up, right? Tests here and leaves, right? Remember, we have an S&D zone here that's not mitigated, right? Price comes back again, tests it, right? This acted as a liquidity high, right? So upon this liquidity high being taken, look at the momentum that price gains and leaves from here, right? So price makes this very huge drop that comes to what? To break structure once again, right? So now you have break of structure, you have a high and a low, right? So you have a what? An S&D zone here, right? An S&D zone. I could probably use this one as an S&D zone. So we're still leveraging, right? We're still leveraging. Okay, so price comes, never gets to it, and then leaves. This happens, right? So now we have a break of structure again. Lo and behold. Okay, so we have a break of structure. And from this break, what do we have in here? We have our S&D zone in terms of what? The last up move before the down move, right? Boom. Okay, so what price does? Price comes up, comes up, comes up, never touches our zone, right? Never touches our zone and then leaves. So this has left a liquidity high and then has made this low, right? Price comes back, takes this liquidity, gives you this some, you know, accumulation sort of thing. Like I think this was off session. Yeah. So this was off session. Price was meant to sold here. I mean, price was meant to sell here. As you can see, this was like it's 15 hours. So this was like the New York session, and price didn't have enough momentum. So it was left lying here. And then when the sessions came, right, when the Asian session, right, because the Australian dollar is on the Asian session, right? So when the Asian session steps up, so the market gives you this some kind of confirm here, and then it leaves, right? So yeah, I mean, I think I did teach you on how to trade on sessions, and if I didn't, then make sure you remind me I do. It's very important to trade on sessions and know the sessions that you're actually trading on. Very important. And so this is like your other trade right here. So as you can see, I was not giving a shit about these intermediary highs or liquidity highs, you know, like they're inconsiderable. Once you have once you have your, I mean, like a structural impulse, an S&D zone, right? If price does this and leaves, don't give a shit about it, right? Don't give a shit about if it leaves again, then no worries, right? That will be a breakout structure, and that will be a S&D point that you'll be looking. Don't force trades in the middle of a trend. Never do that. Never violate your rules, right? You have structure, you have S&D. Wait for price to touch your S&D. If it doesn't, leave it, right? You'll get another entry. You'll get, if even if it's not on that pair, you'll get it on another pair. You'll get it on the next day. You'll get it on the, it's way much safer to preserve or conserve your money than lose it stupidly, I can say, right? It's way better to not be in a single trade for 2 or 3 days and have a single good trade that pays you off for the rest of the week. That's way much better than losing money on Monday, losing money on Tuesday, losing money on Wednesday, and coming to regain or recover your losses on Thursday and Friday and end up the week on break even with, like no significant profit or zero profit or, a small loss or zero loss. It's 100%, 100 times over. It's better it's better you execute like a single trade or 2 or 3 for the whole week that will pay you significantly rather than having 20 or 40 trades that end up make you end up in a small profit or even zero profit, right? Because a lot of trades will just uh confuse you. You don't have to be on the charts 24/7 looking for an entry. You should only execute entries when you see them. Don't sit on the chart waiting for an entry unless you have seen one. That's not healthy. That's not good for a trader. So that's just, some psychological advice. So boom, this right here, this is what we call leveraging. I hope this has been a fantastic little session. And yeah, I mean, following the footprint and leveraging for me, it's the same thing, right? Because you wanna make the most from the price action that you have, right? So you could just have a 4 hour, you could just have like you could have a 4 hour setup like this, right? For a swing trader, they would only take a single trade here, right? And then hold it for the rest of the trend. Like swing traders, most of them use small lots. Why? Because their stop losses, they're very huge, right? Because if you consider the like this zone, right? If you consider a trade from here, I mean there, okay, so let's keep it safe, right? We're playing it safe. So there's our stop loss, and like here's our target. So this is a 1 to 2 RR, a 1 to 2 RR trade. 1 to 2. It means if you risk $100, you're gonna get $200, right? So you only get twice of what you risked. 1 to 2 RR. Very pathetic, right? So these are like swing traders, right? And on the case of leveraging, or what we do on the MMC footprint, right? My version of MMC footprint, not the operandi's, not everybody's, right? So this is exclusive stuff that you'd only get from me, bro. So from here, right? So let's count our RR. So from this trade we have one. So this is like a 1 to 25 RR trade. That's trade number one. Trade number two is a 1 to 9 RR. Trade number three is a 1 to 7 RR, and trade number four is a 1 to 2 RR. Okay, so let's do that simple math in there, right? So let me pull up my calculator here. So first trade is 25 RR, second trade is 9 RR, third trade is 7 RR, right? So this is like 25 RR, 9 RR, 7 RR, and this is 2 RR, right? So this is a total of 43 RR gained. 43 RR gained, right? So this is a 1 to 43 risk to reward ratio. If you risk $100, if like assuming that's a 1%, right? You're actually gonna get 4,300, right? $4,300 as your reward, 43 times of what you risked. So this is the beauty of the MMC footprint strategy in accordance to leveraging, right? So this is how people now grow their accounts, right? So as you can see, like those Instagrammers or YouTubers that post those videos say, uh, look how leveraging works, growing $100 to $10,000. So this is how it's done, right? They just use bigger lot sizes because they don't care if they lose that $100 or whatever, because it means almost nothing to them. So yeah, I mean, this is the whole package. Following the footprint is the same thing, right? Because we are only following what is being done, right? So this is following the footprint, right? Break of structure, retest, break of structure, retest, break of structure, retest, break of structure. That's how you follow